Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now today I wanted to talk about the Canadian dollar. The last time we spoke about this currency, I'd explained why it's popularly called the Toonie after the aquatic bird printed on the $1 coin. However, the currency's love for the wildlife doesn't stop there. The $2 coin, or the Toonie, also contains an image of a polar bear, which seems apt given many Canadians see the town of Churchill as the polar bear capital of the world. So clearly a currency for wildlife lovers. For markets though, it remains very much about oil and interest rates. Now we know oil prices are usually a key driver for the Canadian dollar given energy is a major export. It's something we've spoken about on this podcast before, but interestingly, several reports have pointed out that the correlation between the Canadian dollar and oil has been falling recently, with the Canadian dollar not really keeping up with the most recent surge in oil prices. Nevertheless, the long-term relationship is not something we would ignore and one we'd view as a positive of the currency today, especially with oil markets still being buffeted by event risks. The most recent being the US effort to cap prices by releasing a significant amount of oil reserves and reports that the EU could be considering adding new sanctions on Russia and its energy sector. Today, though, a bigger driver seems to be interest rates, or at least expectations of how far the Bank of Canada may hike rates. A recent Bank of Canada business outlook survey for Q1 captures why markets expect the central bank to raise rates rapidly. This survey showed first, a record 30% of businesses saying they would face difficulty in meeting an unexpected rise in demand given capacity constraints. Second, that 70% of firms expect inflation to hold above 3% in the coming 2 years. And third, that 61% of firms expect input costs to rise as a result of the Ukraine conflict. Now, the central bank next meets on 13th April and markets now see about a 70% chance that will lift rates by 50 basis points. This, together with expectations that the central bank will remain hawkish and continue to lift rates through the rest of this year, is likely to be a key source of support for the currency, especially in the face of a fairly robust US dollar, which has found support from rising rate expectations of its own. Now, what does all of this mean for the US dollar CAD pair specifically? We've been short-term bearish on the pair from just above 126. In the very short term, risk-reward may favor taking profit on an existing bearish views on the currency pair, given it has struggled to break below technical support around 1.245 as downside momentum fades. However, given the fundamental picture we just discussed favors a stronger Canadian dollar on a longer horizon, any rebound could create opportunities to sell into a rally. On the upside, technical resistance at 1.2540 is key and has been capping the pair's range recently, though subsequent resistance sits at 1.2615 in our view. So, please do keep an eye out on our daily FX Navigator for updated levels on this and other major pairs, but we'll sort of end this here. If you enjoyed this podcast, as always, please don't forget to rate and like it. Thanks again for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.